If I had traded exactly like Tastytrade, meaning the same allocation rules, like the same trades that they're placing all the time, how my portfolio would have behaved during the crash of March 2020? That's a question that I often wondered myself, because obviously when you sell options, you tend to have a lot of winners, a lot of small winners, but when you have a loss, it tends to be a lot more than what you win. And that's the picking pennies in front of a steamroller. That's what everyone says when it comes to selling options. And actually, Tastytrade released the market measures where they actually test their allocation rules during the crash of 2020. And in this video, I'm going to react to it, and we're going to see together how would a portfolio behave during the crash of 2020. So without waiting, let's get into it.
Market measures. So testing allocation rules in 2020. Let's take a look. Cool. Since the sell-off of 2020, people have wondered, how can I protect my portfolio against something like this in the future? Yeah, I've wondered that too. How do I protect myself against something like this in the future of another kind of pandemic? Even though the global pandemic doesn't happen too often, it is a very real question that needs to be addressed. Okay, it's fair.
Yeah, of course. I mean, I think it's completely fair to ask yourself a question like, how would your portfolio would behave, if you had followed the Tastytrade way during a crash like the one in 2020? Because the problem is, it doesn't matter if you win 99% of the time. If the 1% when you lose everything, then, what's the point of winning 99% of the time? So yeah, it's absolutely fair as a question. And I think that's great that they test themselves the allocation rules.
Let's go to the next slide. So the answer, of course, is to stay small. But were our capital allocation rules small enough? What do you think? Now, we did this with the piece we did earlier today. And we said if the VIX is over 40, 50%. If the VIX is between 30 and 40, 40%. Between 20 and 30, 35%. 15 and 20, 30%. And 10 and 25, 25%.
So for those who wouldn't know what they're talking about here, basically their thesis is that the higher the VIX, the more capital you're going to deploy in the markets. Meaning that, for example, if the VIX, which is the implied volatility for the S&P 500, is between 10 and 15, then you should allocate 25%, or at least you should allocate maximum 25% of your net liquidity. So for example, if you have, let's say, a net liquidity of around $10,000, then if the VIX is between 10 and 15, you should invest maximum $2,500. And then you follow the different allocation as the VIX is going higher or lower. That's one of the main rules that they're recommending.
And now by small enough, I mean, Tom, you've been in the business, many decades. I've been in the business many decades. It's never small enough when it's going wrong. But what you're really asking is, can you survive these kind of moves and these kind of occurrences if you're trading small enough and small enough by these allocations? With that being said, that caveat, I gotta say, it better work.
Yeah. Can you survive a move that is, can you survive a crazy move that is like we saw in 2020, in March of 2020? Can you survive an insane move? And regardless of what the allocation, or do you have to stay in this allocation? Will this allocation have saved you? That's the real question.
Yep.
That's where we put all our research. So let's take a look. So we looked at the entirety of last year, from January 2020, the beginning of January till the end of December of 2020. We started with a $100,000 portfolio, stayed with a short 16 delta strangle, 45 days to expiration, managed to 21 days. Straightforward, nothing else to it. The number of the strangles in the portfolio was based on the capital allocation rules only. That's it. When the strangles were removed at 21-day mark, new ones were immediately added in the cycles closest to 45 days. So for example, on January 2nd, 2020, with the VIX at 13, the portfolio started with roughly 5 strangles. 5 times $5,000, and buying power reduction per strangle equals $25,000 on a $100,000 portfolio. That was 25% allocation.
What they're saying right now basically is that they're going to study and they're going to test the allocation rules. They're going to look at SPY strangles. So what I understand what they're doing here is that, let's say that right now the VIX is around 13, as they say in their example, meaning that they're going to sell 5 strangles on the SPY. That means 5,000 buying power required per strangle. So that's 25% allocation. So that's how they're going to study. And as the VIX is going higher, they're going to sell more strangles following the previous allocation rules. So that's going to be interesting what they are actually finding as results.
So it all makes sense. Mm-hmm. So we did is we basically just wanted to present this as, as clean as you could, given the allocations that we have, just to see how's this thing going to work out. Let's take a look. So keep in mind that the strategy presented in this study is the most conservative that we would employ. But since everyone has a different risk profile, we have to base the study on some benchmark. So think of these results as the least you would have lost in a sell-off.
One thing to mention here is that they say that's the least that you would lose in terms of drawdown, and that's the most conservative that they would do following those allocation rules. Personally, I feel that, for example, selling 5 strangles on the SPY, even if you have a 100K portfolio, and it's not necessarily the safest that you can do. I mean, personally, if the VIX is that low, like 13, then I'm not going to sell naked options. I'm going to sell credit spreads mostly because of this type of event. But after that, that's actually better that they test that portfolio with naked options, because at least you can really see how is your portfolio behaving when you're selling naked options and you are actually in a crash, and one of the worst crash we ever had. So that's going to be interesting.
So we're backing into this. This is not the most you would have lost. Okay. This is the least you would have lost. All right. Is that fair?
Okay.
So we're actually admitting that it's almost impossible to say, hey, I'm going to be this perfectly disciplined and to do everything the way we did it. We're saying, hey, you know what? That's really challenging. That's really hard to do. But we are going to do everything in the absolute most disciplined way.
Okay.
All right?
Okay.
And then this would be the best you can do in the worst circumstance.
Best you can do in the worst situations.
Yep.
Got it.
Let's go to the next slide. So the biggest drop in the portfolio was around 16% from the realized high on February 3rd to the realized low on March 27th. Now remember, we started off using 25% of the portfolio. We ramped it up to using 40% of the portfolio. Mm-hmm. I'm sorry, we ramped it up to using a max of 50% of the portfolio, and then we cut it off there when the IV got over 40, when the VIX got over 40. So what you see is the portfolio value at the top, across the bottom, at the pre-sell-off high, at the pre-sell-off low, and then at the post in the very end.
So what's interesting to note here is that, as you can see, what they're basically showing is the portfolio value over time. And as the VIX is going higher and higher, for example, it goes from 13 to 18 to 66, then back to 23, they're allocating more percentage of the portfolio. They're allocating more buying power to strangles as the VIX is going higher, and then they stop. And actually the drawdown that they have, the least that you would have had in terms of drawdown is around 16%. And obviously that's the least that you would have had if you had exactly followed the allocation rules. So after that, looking at the SPY, I think he lost around like 30%, 35%. He's somewhere around 35%. If you were losing 16% during that time, that's actually quite nice. But obviously, as they just mentioned before, that's the least you would have had in terms of drawdown. So, that could actually be a lot higher if you were allocating more buying power to other trades.
Using the perfect allocations, just using 16 delta SPY strangles and nothing else.
I mean, anybody can do whatever they want. It's not something typically that we would do, right? I mean, we're not going to have a portfolio made up of just SPY strangles, but for demonstration purposes, I get its place.
And we're not going to sit and be exposed direct. We're not going to be as perfect as this whole thing.
Of course.
But we wanted to show when the VIX was started at 13, when it went to 18, when it closed at 66.
Like you said, the allocation's ramping up because the volatility was ramping up. I mean, they're doing everything, by the book.
Yep. 25, 30, then to 50, back to 35.
One thing to mention here, and I got very, very lucky during the crash of 2020. I didn't get hurt that bad, but something that is really important to mention, it's really easy to say on paper that you're going to take more positions when the VIX is going higher because there are more opportunities and blah, blah, blah. But when you are actually experiencing something like this, it's extremely hard, for example, to sell a put when there is a crash. Even though, you see the VIX going higher, you have more opportunities. Good luck selling a put during a crash, because obviously you don't want to catch a falling knife. And personally, when I would see the SPY falling, I knew that there would be opportunities. Now there are opportunities, and if I was selling a put, I would actually get a ton of credit. The problem is you don't want to catch a falling knife. So on paper, it's really easy to say that you have to ramp up your allocation, but when there is a down move happening, you just don't know where the bottom is. So you don't want to catch a falling knife. And it's a lot harder actually when you're experiencing this in real life to take action because you don't want to get hurt.
Okay. And then the percent return from the previous event, just so you can see where the losses were, where the gains were. I mean, obviously, the big loss happened when the vol went up to, 80 and then closed at 60.
Right. And they're not rolling down the untested side or anything in here, correct?
No, there's no rolling. There's only, there's no adjustments.
Okay, so that plays into it. I mean, I know listen, you can't look back and come up with a study that has subjective stuff to it. Like, I'm going to roll down the untested side when I'm breached, or my delta gets too big. That's the human part of it that we want you to employ into the strategies. But this is a good look-see.
Yeah, this is just manage at 21 days. That's it. No matter what, manage at 21 days. And so what you can see here is that is the course of the most volatile year in history. That's the interesting thing. The most volatile year in history, sticking straight to the numbers, using the SPY. This is how it came out. So the 100 turned into the lower 100, went down to 94, closed the year at 97. Not horrible, not great. It just, that's where it was in the most volatile year in history.
Sure.
If you stick.
I mean, personally, I feel that already, for example, selling 5 strangles on the SPY, even though you have a 100K portfolio, when the VIX is at 13 is extremely risky. I think that's like taking huge risk, and I would never, for example, sell naked options on the SPY when it's that low, because if there is a down move happening, I mean, your P&L is just going to go underwater very quickly. And I think it's way better to sell credit spreads when the VIX is low. That's personally what I do. And when the VIX gets higher, then, it's your moment to shine. That's the moment where selling naked options makes more sense, because now you have more opportunity, you have more premium. But when the VIX is low, when the VIX is under 20, I'm going to stick to selling credit spreads. And honestly, I've found that it's an amazing way to mitigate losses, because even though there is a crash, let's say that tomorrow there is a crash that happens. If you have been selling credit spreads, nothing prevents you from turning your credit spread into a naked options and just taking your profits on your long leg. That's a very good way of mitigating losses during a crash. And I feel like you don't lose much by selling a credit spread instead of naked options if you make it really wide. For example, I like to sell the 30 delta option, and then I'm going to buy like the 5 delta leg. So that allows me to sell very wide credit spread, keep most of the credit. And yes, okay, I lose a lot of times, actually most of the time on my long leg, but the day where there is a crash, you're going to make so much money thanks to that long leg that is going to help you mitigate the loss that you're going to have on the short leg. I don't know if that makes sense.
Stuck to the game plan. Let's go next slide, which was hard to do.
Of course.
Best case. So utilizing a more aggressive strategy like the SPY 30 delta strangles and a mix of individual stocks that carried higher implied volatilities, but still sticking to the allocation guide, would probably multiply your portfolio losses by around 2 to 3 times. This means that the average aggressive portfolio would have been down around 40% from the high in February to the low in March, but would have mostly recovered by December. So, and I think that for a lot of us, we definitely experienced those kind of swings Like my swings were way bigger than.
And I feel that, that's actually, I would expect to see more drawdown. I was quite confused that it was only 16%, but now it makes more sense if you're, for example, going for a more aggressive approach where you're selling 30 delta strangles, for example, it makes more sense that it's going to be around the average, like around 35%, what the SPY actually lost. So, I don't think that necessarily that's personally how my portfolio would have behaved during the crash of 2020, because I just like to sell credit spreads when the VIX is low for that exact reason. But like that's a good benchmark, and if you're, for example, selling naked options on individual stocks, it gives you a good idea of how it's going to behave. And honestly, seeing 40% drawdown during the March 2020 crash is actually quite scary, especially Tom Sauce. Now I can't even imagine his portfolio size, and seeing a drawdown of 40%, I mean, I would just pass out looking at the monetary numbers, the monetary drawdown. I think I would have passed out already. But yeah, that's actually quite representative of selling options, unfortunately. Like either you sell options, you have tiny wins, but when you lose, like for example in the case of a crash, you lose a ton, or you like to buy options, your win rate is going to be a lot lower, but when you win, you're going to win a lot more. That's always, you have to choose your side, but there are no secrets. There are no secret strategy or anything. Both sides have their goods and bads, that's for sure.
So I just bring that up because I think that everybody has to, like I said, that was the best case scenario. Mine was not the worst case, but it was like somewhere in between.
Sure.
Okay.
Fair to say.
Yeah. So what we did here today was give a real view of a best worst case scenario for 2020, and then also give whatever the multiplier would be if you were using, individual stocks.
Most towering line drive.
Yeah. And so, and people are like, well, I'm not really sure, what's your point? Where are you going with this? And the point is really just to show kind of how interesting the math plays out, regardless of what the market does, because you only have 5 years out of the last, basically just under 100 years where you've had that kind of movement, which means that virtually in virtually every other marketplace, you got to be pretty good.
Yeah.
I mean, the numbers have to play out.
Yes, okay, fair. I get why he's saying this, but the problem is, you just need 5 years out of those 100 years to just wipe you out. I mean, it doesn't matter how often you're going to win. If the only time you lose, it wipes out your whole account, then, what's the point of just trading options? So I don't think that's a valid argument of saying it really doesn't happen often, because times and times again, it has been shown that it doesn't need to happen often. Any event that has a very low probability of happening, you look like, for example, a pandemic, or let's say a crash, or whatever it is, it can have huge effects on the world, and it can absolutely change the whole game. So it really doesn't matter how often something bad happens, because if it only happens once and you're being wiped out, then you're losing everything, and the other 95 years are just going out of the window.
That's all. Let's go to the next slide. So comparing this to the S&P 500, which lost about 36% from the February high to the March low, the losses in the conservative portfolio were around half that, and the aggressive portfolio lost a bit more than the market. So this is the importance of not over-allocating when the implied volatility is low. Had we been allocating above 50% of our capital during the sell-off, losses would have been around 25 to 30% for the conservative portion, around 70% for the more aggressive portfolios, meaning a quick recovery would have been near impossible.
Yeah, I agree that's so important to not over allocate too much capital when things are going fine, when the market is grinding up. You need to be really careful about this, because just look at this, 70% drawdown. I don't know anyone in their right mind who would continue trading after this if they had a 70% drawdown. That's insane. Imagine, let's say that you trade a 100k portfolio like they were showing before. That's a 70,000 drawdown. I mean, think about this. Are you ready to trade trade that aggressively that if you have a drawdown, it's going to be 70% of your account. Personally, I'm definitely not. I'm definitely on the conservative side. I'd rather, earn less money on the short term. I'm fine with this, but I don't want to have a 70% drawdown. I don't think, anyone in their right mind should trade aggressively and experience a drawdown of 70%. It's going to crush you. And, I think that a lot of rising stars that they have been bringing on the show have been way too over leveraged. I mean, when they were sharing their P&L, like how much return they would have over the years, and for example, if someone tells you like that they had like 100% year on year, that means that they're way over allocated. Like they shouldn't be trading that much. Yes, okay, on the short term, they maybe made a lot of money and made good returns, but in 2020, I'm wondering how they have actually performed.
What's really interesting about this, and again, what we have to take into perspective, can you go back to the first slide, Beth, for just a second? Which I think is so, no, I'm sorry. The one before, I'm sorry, the next slide. Next 2 slides. This is 2, go to 4. 5. Yeah, sorry.
Would you believe 5?
Yeah, so when you look at the decline in portfolio value at the bottom of the page where it says return from the previous event, when you look at where we were in the beginning of February to where we dropped at the low of March 27th, okay, because that's really the key, the March 27th low. The loss here is 15.7% on this approach on your entire $100,000 portfolio. But remember what they're saying here. If you had $100,000 worth of stocks at that same time, just a straight long portfolio, not an option portfolio, you're down 36%.
Yeah, but that's not really also an argument, I feel, because, if you have, I get what he means that, like, if you had just invested in the SPY, but for example, if you had invested in dividend stocks, like, let's say, dividend aristocrats, they have been showing over and over that when there are crashes that happen, dividend stocks tend to outperform normal stocks, meaning that you would lose less money if you had, for example, been investing in dividend stocks compared to the SPY itself. You cannot compare a conservative option portfolio to a regular stock portfolio because you need to compare apples to apples. So for example, a conservative option portfolio would be interesting to compare it to, let's say, a dividend aristocrat stock portfolio where they tend to lose less when there is a crash. Now I feel we're comparing more apples to apples, but that's my opinion.
Right, significantly more, sure.
You're down 36% in the S&Ps. We're not saying that this is better, worse, or anything else. Okay, we're just merely pointing out that it's not that black and white, that just being passively long is that much more conservative or that much better, any of that kind of stuff.
Okay, yeah, on this I agree. I agree that this is usually what the underlying assumption is, meaning that like when you invest passively in the SPY, you're going to do better off and everything. I mean, I agree with him that this is not really better to actually just go passively or invest in an index fund, for example, in the SPY, because, if you have a drawdown of 36%, then you might as well trade options in a more conservative way. And, just looking at the SPY, it makes sense what he says.
Or that easier to hold for the long haul or anything else like that. Yes.
I mean, if you think it's easy to sell a strangle when you're down 16%, what do you think it's going to be like to buy stock?
Right. Exactly.
After you're down 35%.
Yeah, everyone has the same problem. Like as I just said before, if the market is dropping, that you have an opportunity to, for example, sell very expensive options. Personally, I feel it's very, very hard during a down move to really take advantage of this because you don't know where the bottom is and you don't want to catch a falling knife. Exactly like someone who would want to buy stocks when there is a crash happening, you just don't know where is the bottom. It's hard to compare the two. And personally, I feel like, as I said before, dividend stocks are definitely a great way to invest if you want to invest in dividend stocks or in stocks in general. But investing in the SPY, just like an index fund like the SPY, then you might as well trade options in some cases if you want to be active at least.
It's hard. Let's go to the last slide. A conservative portfolio managed mechanically the Tastytrade way lost 16% from high to low during the 2020 sell-off, rolling not included, Tony. Around half of the S&P losses. A more aggressive portfolio would be estimated to lose 2 to 3 times more, around 1 to 1 or 1 to 1.5 of the S&P 500 losses. So the key is not over allocating capital. Like in 2008, if a portfolio was allocated below 50% of the available capital, the losses would have been recovered over time.
Yeah, I mean, I think that's the biggest takeaway like of this whole video. And usually when you're trading in general, especially when you experience some time of big down move and you lose money, is just to not over allocate when the VIX is too low, meaning that when the stock market is grinding up and we are in a very complacent phase, then just don't over allocate your capital, because you're going to regret it if there is a crash that happens. And that's why I said before, I feel like, for example, a lot of rising stocks that they have been bringing on the show are way too over allocated, and there is no way that they achieve the returns that they have achieved without taking like big risks. And I think that's a very dangerous line that, we're always playing when we trade options, is that you really need to be mindful. And I think you need to experience once like a very big down move, and then after that you understand why not over allocating too much is so important, because it can crush your account. Literally, it can make you blow up. Let me know what you think in the comment section of this reaction video. I thought that was really interesting. I like the fact that they are going to test their own strategy during a bad time, because obviously, when everyone is earning money, it's easy to say, look at my strategy. But I like the fact that they have the transparency, the honesty to at least test the strategy out during a crash like the one in 2020. And I get what they mean by it doesn't happen often, but the problem is with the stock market, it doesn't need to happen often for you to lose money. If you have any question or you have any comment, please don't hesitate to put it below. I'll be happy to answer any question or any comment that you might have. Please make good and informed decisions. I'll see you in the next video, and in the meantime, I wish you all the best.